Hi, welcome to this video today, which is all about Forex trading for beginners. What we're going to be looking at in this video is overcoming two key obstacles to success. Now, in terms of most beginners, they cannot overcome these obstacles and they end up in the 90% of losers. You need to overcome the obstacles. They're easy to overcome once you understand why they occur. Now, both obstacles are related to what is called hyperbolic discounting. If you don't know what hyperbolic discounting is, it'll become clear as we go through this video. But it's all to do with the way the brain rates recent information over older information. This will bring out two key biases: recency or present bias, and also the availability bias. So I'm going to start with recency or present bias. I'm just going to show you a short intro clip which illustrates it perfectly. Notice how the people, when they're asked a question, they give totally the right answer. Then the question is rephrased and they're all going to give the wrong answer. Right, the video clip's coming up. It's only about a minute or so long. Then we'll be back to discuss in more detail.
We asked shoppers in a Chicago mall if they would prefer $100 in a year's time or $102 in a year and a day.
I'll take the $102 in a year and 1 day.
$102.
Year plus a day.
And then I can wait that extra day for the $102.
Yeah, for extra $2.
Yeah,
it really will make me a difference.
I would do the 102 a year and a day from today.
They all made the rational decision.
What's 1 day after a whole year of waiting?
And chose the larger amount. Then they were asked if they would prefer $100 today or $102 tomorrow. The larger amount is still the rational choice. So what did they say?
Oh, I'll take the $100 right now.
I would take $100 today.
I would prefer the $100 today.
Today.
I'm taking $100 today.
The desire for a quick reward
$100 today.
trumps their rational self-interest.
There's something called present bias, that if we have the option of something right now, it's very tempting to go for it.
I will come back after that short clip and you can see the temptation to take an instant reward. It's obviously logical to wait the extra day. Now that temptation comes into play in the Forex markets when traders are looking at open profits, and a common problem is deep down they think the trade is, let's say, going to the upside, but it stalls or reverses a little bit and traders think, oh, best get the money in the bank. Gives you a dopamine hit in the brain, which makes you feel good as well, but it's not the right thing to do. Now, traders face another problem. If the trade has not moved too far from their entry and haven't got their stop up so they're in profit, they don't want to see a winning trade become a losing trade. And keep in mind, psychologically, you hate losing twice as much as you like winning, and that's easy to prove and has been done so psychologically. I'll just give you a simple example. If we did a coin toss and I said, if it lands on tails, then you are going to lose $1. How much do you want to take the bet? You're going to ask for $2 probably. That's what most people are going to ask for. So we have what we call loss aversion. And running profits and cutting losses, it's accepted investment wisdom. Running profits is really hard. I'm going to come to some tips on how you can run profits in a moment. Now, a lot of traders actually think that they can trade for small moves and make nice regular profits. There's a big industry telling traders, they can aim for 10, 20, 30 pips and make money over the long term. You can't, okay? But the reason all traders think they can is due to another bias which is going to come into play. And it's a bias that a lot of traders think about. It's called the availability bias. Now, I just want to, on a storyboard, just go through a couple of quotes and a question, and then we're going to come back and go through, how to avoid recency bias and availability bias, which we're going to discuss now. So let's go and take a look at the storyboard. All right, let's just go through these few points very quickly. Now, in terms of hyperbolic discounting, it basically focuses us on immediacy, okay? And we've seen that in terms of taking action, especially with money. But what about our responses to available information? Now, this is availability bias, and we've got a lot of information that is available to us. A lot of it is sensational, a lot of it is wrong, and we can actually be encouraged to act on the wrong information. Now, let me just pose a simple question, which you can see the answer to, but the question is, which has killed more people in the last 50 years in Australia? Is it shark attacks or parts falling from aircraft? Well, the answer is parts falling from aircraft by double, but you don't hear about that, do you? It's not as sensational as a surfer being attacked by a great white shark. And the media wants sensational stories. You know, someone getting hit with a bit of debris from an aircraft, isn't that sensational? And, you know, this pervades the media. Sensational stories are put forward. And of course, we live in 24-hour news channel world. And you got to make finance interesting and exciting. You got 24 hours to fill. The media will bombard us with information. Much of it is wrong or sensational, but it's going to appeal to our biases. Now, in terms of financial news, many events reported are sensational. There's plenty of sensational stories that never, ever come true. You get a few each week. My favourite one is the death of the USD, which has been around since I first came into finance in 1986, that the dollar is going to disappear and another currency is going to take over. The Japanese yen at one time, then it became the euro. We even had the Chinese one. It hasn't happened. It's probably not going to happen, okay? But it's a story. It's sensational. And there's plenty of them around. And, a lot of the news, even small events, can become really significant, the way the media portray them to traders. So, for example, the US dollar might fall a little bit, maybe 30 pips or something, and then you get a story that has caused the fall, which is housing starts in the US declined. It probably had no impact on the USD. It's really just a bit of noise, but there's a story fitted to it. Every little news story has to have some significance to the media, and a lot of small stories are just built up out of all proportion, when really the price just moved a little bit. And you've got to think about it. If you're watching a US dollar pair, you've got a little bit of profit, and suddenly you hear housing starts or the start of the big decline in the US dollar, that's going to tempt you even more to take in a little bit of profit, isn't it? And I think when you see every little news story, it's significant, and it's explained after the event, that gets traders in the kind of frame of mind that they can trade all those small events as well. That it's trading noise. Immediacy, news that is current, immediate, sensational, it's available. You can very often act on it, or traders do. Sensational news story, or a story maybe a little less sensational, which is blown out of all proportion. Now, you obviously got to avoid availability bias and filter the right news. So let's discuss that in a little bit more detail. Right, let's have a look at how to overcome present bias first, or recency bias. Now, in terms of overcoming it, what you want to do is get used to the fact you've got to aim for realistic profits over your stop. Your stop has got to be outside of the noise. And I would say, as a general rule, you're going to need at least 100 pip stop loss. So basically, going for 30 or 50 pips is going to get you nowhere. Aim for 200, 300 pips or more, and do not focus on winning the majority of your trades. You can make money losing the majority of your trades. We do so here. It doesn't matter the winning percentage, difference between winners and losers. Now, one thing you must do is do not look at price action too frequently. I say this a lot in videos. 2 or 3 times a day is plenty. If you're sitting there staring at a screen, then basically you're going to get psychologically sucked in, see small moves in the short term, which probably don't mean anything in the big picture, but you're going to be tempted to act impulsively. You need to avoid it, okay? So stay away from the screen. Now, of course, some people sit around looking at a screen because they're aiming for small pit profits. That's ridiculous. Yeah, I know a lot of people say that you can do it online. They've never got any real track record to show that they can do it. And of course, it looks easy to do because the media are fitting news stories after the event to the price action, but they may not have caused the price action at all. It was probably just noise. If you're going to be looking at news stories, look at big ones. Do not look at something like housing starts. You're going to focus on, inflation, central bank meetings, GDP, etc. A lot of news events come out each month. 10,000 in relation to the American economy are released by the Fed. Very few of them really make any difference to us as traders. Very much less is more in terms of when you look at news. And a lot of news, it is just stories, it is just entertainment, it is just sensationalism. So in terms of the biases, they're there for a reason, to help us survive as a species, okay? But in the Forex markets, they're a danger to your financial health. Now, in terms of the video, I hope you found it useful. Thank you very much for watching me. Take care and have a good day.